Welcome back to this lesson. In this lesson, we'll be talking about sell stops. We are going to learn on sell stops. So, what are sell stops? These are orders that are below current market price or orders that are below swing lows. So, let us look at an example because this requires charts. So, also, what is the importance of sell stops? So when you see that the market has run some form of sell stops or sell side liquidity, it means that there is a backing of, there is institutional order flow, and also there is backing of smart money, and also there is, when we see that sell stops have been run, we know that there are orders which have been paired, and it shows that there is injection of liquidity into the market. So when we look at this example of the daily chart, let me show this example here. So when we look at this instance, we can see that there was a form of relative equal lows at this point. So sell stops are, we have said that they are orders or built up orders which are below current market price. So these are sell stops. They are orders which are below current market price. So they are found below daily highs, swing lows, daily lows in the market. So when we find that we have a swing low, for example, this is a one swing low, another one, so they are relatively close to one another, and we can see that this second swing low did not come to run this first swing low. So we can see that they are relatively equal lows. So when we get this instance, we anticipate that the market will later in time, not a must instantly, because you can see that in this instance the market did not run that liquidity for a period of 35 days. That's like a whole month plus. Then we later found that the market came back down, then moved higher towards the price the price range in which it was initially going. Let us look at more examples in lower time frames. 5 minutes, 1 minute, 1 minute chart. So in the 5 minutes, we just come and outline this swing low. So when we see that when we get in price that there are relatively equal lows, so we can see that this low was at, we are looking here, this low was at 103.981, and the next one was 103.981. So when we get such a instance where the market does not come for this first level of liquidity, but it continues to hang above, that I can say is when we anticipate or start to anticipate that the market may run that form of liquidity, and this liquidity is the sell stop. So these are sell stops. So we anticipate that the market will run these sell stops, then when we run, we get a movement away from it. So these are built up orders below market price. So we can see what happened next. Market ran this liquidity at this point, then we got a break in market structure. So that is the sell stops for you. So go back in your charts, look for more examples. There are many examples in different time frames. In also the 15 minutes, you get many examples. The lower the time frame you go, the many examples you get. Even here, this is an example, relatively equal lows. We can see that even though here we came and ran this form of these liquidity sell stops here and we broke structure, but you can see that later on the price did not move away significantly from this level. Instead, we came back down, ran it again, then moved higher. Yeah, that's sell stop for you. Here, this is a sell stop. These are liquidity in the markets. So these sell stops is where you find that retailers, they come. So if someone saw this as a buy opportunity, they place their stop loss here. Then instead of market running higher, it comes back down for that liquidity. So that stop loss that you place, that money that you injected into the market, is the liquidity, which is now it's either unwilling or unwilling. So even if you were unwilling to give that market that money that you injected, it's like you are forced to part ways with your money. So you, as a trader, you become now the liquidity. You provide that money to that informed person or speculator or the banks or the smart money or the market makers. Yes, that's it for this one. See you in the next lesson.